Hi everyone, welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets. In today's webinar, we'll be discussing some live price action. It's been a quietish start to the week, so you will see that some of the markets are in holding patterns, but we do have some important macroeconomic events happening later on in the week. And that should provide us plenty of tradable opportunities towards the latter parts of the week, and potentially into the early next week ahead of the Federal Reserve meeting. Before we begin the webinar, please have a read through the risk warning and the disclaimer. I'm going to help you by reading the first paragraph. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Right, so for those of you who are new to this webinar, it happens every Tuesday, 11:30 London time. We talk mostly about technical levels on the on live charts, but we do touch on fundamentals as well. There is a Q&A session at the end, but if you do have any questions, before the end of the webinar, don't hesitate to ask in the questions or in the chat box, and I'll get to those questions as and when I can. All right. So this week, the Bank of Canada, European Central Bank policy meetings are among the key macro events, but we also have the US CPI. Remember, it's all about inflation at the moment, and so far, the Fed has said that the rise in inflation is going to be transitory, and that it's going to fall back eventually, meaning that they're not going to hike interest rates just because the inflation has risen above their 2% average target. But if inflation turns out to be sticky, then obviously that would cause them to tighten their belts. But in so far as this CPI is concerned, I think if it comes in really strong and well ahead of expectations, then it may alter the thinking of some of the policymakers at the Fed, who are meeting next week, and that's going to be the next major macro event for the markets. So insofar as this week is concerned, we have that CPI data from the US, but we also have two major central banks, as I mentioned, European Central Bank and Bank of Canada. Both these central banks are unlikely to do anything significant. The European Central Bank is likely to reiterate the need to keep emergency measures intact, because the Eurozone economy is still recovering and there's still a long way to go before we get closer to the time where we can look forward to the end of the pandemic. So you can rest assured that the ECB head, Christine Lagarde, is going to tell the market that that QE is going to stay in place for a long time to come. That should help to push European equity markets further higher. And insofar as the euro is concerned, I'm not really sure what it will do to the euro, because on the one hand, obviously, if the ECB is going to keep QE running at full throttle for longer, it should mean weaker exchange rate. But on the other hand, right now, FX market is really following the equity markets, right? So when it's risk on, when equity markets are rising, you see the dollar going down, and that in turn supports the euro dollar and other major currency pairs. So if the ECB does turn out to be quite dovish, as people expect, then that will likely help support equity markets in Europe, which in turn might actually provide support for the euro-dollar exchange rate, contrary to how it would traditionally work. So bear that in mind if you trade the euro-dollar. We do have some economic numbers from the UK and US on Friday. I don't think they will be too important in the grand scheme of things. But yeah, let's start off and look at the live charts. And As always, I look at the dollar index to start the webinar. And, from the previous webinar, we mentioned that the dollar index had created a couple of bullish looking candles. But this is what I expected, that we will get a push above the previous week's high. I drew this on Friday, by the way. I think it was Friday or on Tuesday of last week, that we would get a move above last week's high, which we did. And then I thought it will go back below, which is exactly what happened. And then we may see some further downside follow through, depending on CPI and other macroeconomic numbers that are coming out this week. So far, the dollar index is following the path from the previous update. But it remains to be seen whether we will break to a new 2021 low, which I think is very likely, because we are sitting very close to these lows. And usually when the market is so close to a previous low or a previous high, usually, but not always, it breaks through. Okay, so I reckon the dollar index is going to break through this area of support, and what it does afterwards really depends on a number of things, including the FOMC meeting next week. So far, the trend remains bearish for the dollar index. So if you look at the daily chart, it found resistance right where it should have. I highlighted the low of this candle in the previous webinar, and look where it bounced from, right into that resistance, and then it sold off. Still hanging in there. It hasn't really taken out the recent lows. There's still a possibility we may see the dollar go back up from here, but the more likely scenario, as I mentioned, is for the dollar index to go below this low here. So I reckon it's going to do something like that, go back up a little bit and then go down once again, something like that. Okay. The euro dollar is obviously going to be in focus, because we have US CPI this week and we have European Central Bank meeting. Now, the euro has created lots of bearish price action, but without any follow through on the downside. So if you look at this phase of the sell-off right here, the market went down for a time. It looked like it was going to break down. It didn't. It went up and took out the high. Same pattern here. It formed the high, broke down a little bit, looked like it was going to take out the low. It didn't, and it went up, taking out the sellers' stops that were presumably resting above these highs. And so this pattern has continued several times, taking out this high. But the big stops are resting above the January 2021 high right here, which is, I think, where the euro is going to head towards in the coming days and weeks. So far, price action is continuing to look bullish. The buyers are coming in where they should be. We highlighted this level, if you remember from our previous webinar, the breakout area here that remained untested. It came crashing down to this level and it bounced from here. So far it's looking positive, albeit it's not really a clean trend. It's been very difficult to trade this market, because price hasn't gone really in a clean fashion, right? It hasn't gone up cleanly. It has been quite volatile. But essentially, the trend of higher highs and higher lows continues to remain in place until the charts tell us otherwise. So my invalidation level for the euro dollar is this low here, because that was the last significant low created prior to price making a break above this high. So I don't want the euro dollar below this level if I'm still bullish. If it goes below this level, I think that would be a bearish development. Likewise, the cable has reached our kind of bullish objective from the previous updates. Now it's gone into another consolidation zone. So I think it's going to do something like how I've drawn this purple line. But I'm not too sure, because a lot can happen this week and in the week after in terms of the CPI and FOMC meeting. But for as long as it holds the 21-day exponential, the path of least resistance, it's continuing to remain to the upside. A few other pairs that are catching my attention. Oh, we've got a question. Yesterday at 7 a.m. Australian time, the Swiss franc Japanese yen had a large blip, which took out my trade because of stop loss. It immediately corrected back to where it started. I couldn't see why it changed so much and made me wonder the benefit of the stop loss strategy I had in place. Was there a period where there was no trading and that's when trading resumed? I'm not so sure. Let's have a look at the Swiss yen. I don't normally look at this trade, this currency pair, but let me find it. I'm sure it's here somewhere. I might be looking right into it, but I can't see it. So let's have a look. So yesterday, presumably you're talking about this daily candle here. It doesn't look too large a move. It's quite normal. It looks quite normal to me. The reason you may have got stopped out is because of the fact that, you know, if you look at price action here, you know, a lot of people will have placed their stops below the trend line because they thought if this trend breaks, then we want to get out. So if you look closer to the lows of the previous candles, right? So you've got this low, this low, this one, so many lows converging around similar areas. So there's going to be lots of stops resting below these lows. And in a bullish trend, it's quite normal for the market to shake out the weaker hands, take out the stops before resuming higher. And unfortunately, that's what has happened to you by the looks of it. Price breaking previous lows and then going higher. And this is quite similar, quite a normal way of the way of the market functions. If you look at this area, for example, here, see how it took out the lows before going up. You know, with the placement of stop loss, you have to be very careful. Another example here, took out the low, then it continued higher. Another example right here. See that? Low was created, price came crashing down, took out the weaker longs, and then it continued higher. These types of stop outs are quite normal in the markets. You have to think about where to place your stop loss, because if you have it too tight and you always run the risk of these kind of stop outs, right? Because the market is a function of liquidity. It moves from one area of liquidity to the next area of liquidity. So in this case, this area here was an area of liquidity because there's lots of stop orders resting there. So funds that want to buy this currency pair, they want to go long, they need people to sell in order for their orders to get filled. And so market makers, they have to push price down to areas of liquidity, like where your stop loss was resting, in order to fill those presumably large orders. I say that those orders were large. Those orders were large because look at the market reaction; it went up quite sharply, right? So you have to be very careful where you place your stops. You don't want to place them too tight to the market. Yet you don't want to place them really far either, because the further away from market you place your stop loss, the more price will have to go in your desired direction before your trade can become profitable in terms of how much you've risked relative to what type of reward you're looking for. So, for example, if you're looking for a 2-to-1 in terms of reward to risk profile, if you had placed your stop loss somewhere at 121, for example, then price would have had to go all the way to 123 or something like that for the trade to for you to make the trade worthwhile for you to take. And that might be a big ask for the market to rally that much without taking its time or without pulling back and so on. So the way I would place my stops is I would place them at levels where if the market got to that level, my analysis would no longer become would no longer remain valid, right? So in this case, I don't know to be honest where I would have placed my stop, but where you placed it is presumably around this area. You place it right at support, right? This is support because it was previously resistance, as you can see by the wicks of these candles. Previously, the market had difficulty breaking through this area. I can move this a little bit lower. Just 1 second. So this area here was previously resistance, right? Look how much the market struggled to get through this area. Eventually, it got through it on this particular day. Then it came back down to retest that area here. And then again on the day that you got stopped at before the market pushed higher. So your stop would have had to be somewhere below this support area to have been a safe distance away from being taken out by short-term price spikes. I'm not saying that I would have placed my stop below, well below this area. Maybe I wouldn't have taken this trade. Perhaps I would have been, I would have considered taking the trade, yesterday when the market created this hammer candle, providing us a bullish signal. In that case, I may have placed my stop below the low of that candle. Obviously, this is not a trade advice. I'm just giving an example. But yeah, like I think you got very unlucky there. It happens. It happens to a lot of people and happens to me sometimes as well. It's just the case of being careful where to place your stop. I don't think there was news per se to cause this move down. There may have been. I think we had the Japanese GDP or something at the start of the week. Maybe that was it. But in any case, to me, it looks like a normal move in the market. Nothing out of ordinary. So I hope that answers your question. Let's move on. I want to talk about the FTSE because the FTSE is looking quite bullish, right? Central banks around the world are continuing to keep QE purchases intact as the major economies reopen and pent-up demand and so on is going to hopefully cause the global economy to recover really strongly. And for that reason, we've seen equity markets around the world hit record highs or multi-year highs. Yet the FTSE 100 hasn't really gone anywhere in the last several weeks. Since peaking in April and mid-April here, you can see that it has oscillated between this level for several weeks. Meanwhile, if you look at the DAX, for example, it's taken out resistance. It's gone up. The S&P has kind of edged higher. The Nasdaq has recovered. The Russell 2000. You get the picture. The Australian index. Look at this. The Australian S&P index has broken to record highs. In mainland Europe, if you look at the likes of the CAC index, that's the French CAC, continuing to push higher. Spanish IBEX, same story. German DAX, as I mentioned. But the FTSE hasn't really done that yet. It hasn't really broken out. So the key question is the FTSE about to play catch up with other markets and break out from this area of resistance, from this area of consolidation. To me, it looks like that's going to be the case because the trend is bullish. We have taken out this short-term bearish trend line. The index is holding above the 21-day exponential. It's created some interesting looking candles over the last couple of days, these small hammer candles. So volatility has been tightening here. Usually when the market coils like this, usually it will be followed by a big release. In this case, I think the release will be to the upside rather than the downside. I could be wrong, of course, but given how the other major indices are trading, I think the FTSE is going to catch up and take out the May 2021 high and possibly head to the 127.2 extension next, ahead of potentially more gains in the future. So the FTSE is on the verge of a breakout. And so keep an eye on this index. If you trade FTSE with us or with other brokers, maybe you could look for long trade ideas on this potential on this market. Excuse me. So yeah, that's the FTSE. Let's look at some cryptos. Actually, let's look at some commodities before we look into cryptos. Crude oil has hit $70 in the US and it's retreated from there. This shaded region was previously resistance. We could see some support coming into there if oil pulls back to this area. So if that area holds, then we may see another run towards 70 or potentially higher. But if that area of support breaks, then you could see it go back towards this level here at 64, which was the base of the most recent breakout. Okay, so that's crude oil. In the US, same story for the UK crude oil or Brent. It reached the March high and now it's pulling back a little bit. Shaded region here in green is where the next area of support comes in play, between 69.75 to 70. We may see a bounce there. Gold has held the 21-day exponential after a sharp sell-off into the moving average. It's holding near the recent highs ahead of the US CPI and ECB meetings later in the week. I think because bond yields are breaking down a little bit. Where are they? Yeah, if you look at bond yields, this is the US 10-year bond yields. We're still inside this bull flag. It's very ugly looking for now. Let's just call it some, consolidation between 1.5 to 175. As yields ease off the highs, this increases or reduces the opportunity cost of holding gold, an asset that doesn't pay interest or give you dividends. So when yields fall back, usually gold goes up, right? So with the dollar also coming under pressure in recent days, I reckon gold is going to take out the recent highs and test the 61.8 Fibonacci extension against the all-time high, but possibly go a lot higher than that over time. Same story with silver. I was expecting silver to up when it was still holding above this bullish trend line. It has now broken the trend line. So I'm not as silver is not looking as strong as it did a few weeks ago, but nonetheless, it's still holding to the 21-day exponential. It's still holding above some key support levels. This area here, around 2750. Is still holding. So there's still hope for silver bulls. It just needs to create a trigger. And the trigger for me is the high above this bearish candle. See this large red candle, or black in this case. So when this when a candle like this is formed, usually you should see downside follow through. But if instead we go above the high of this candle, it would strongly indicate to us that the sellers are getting trapped. In which case, price could then rally and go on to levels where trapped sellers and stop loss holders would be risking, such as the high of this candle here at 28.75 and at around 30. So those are the next bullish objectives should we take out the high from this large red candle or black candle at 28.25-ish. Looking at silver on the hourly, is forming some nice candles here, right at support as well. This area here was the previous trouble area before it released, right? Came back down, retested it. So far it's holding. It's a very similar price action to over here when it was testing this former resistance level. So could we see silver start a rally from here? It looks quite likely in my view, but let's see. As I mentioned, that level needs to break on the daily at 28.23. Right, time for some cryptos then. Starting with Bitcoin. Bitcoin has disappointed the sellers, the buyers, right? It looked like it was going to break out to the upside from this continuation pattern. Sorry, not continuation, from this consolidation pattern. When it took out the resistance trend on this particular day, it should have continued higher. But on the very next day, the breakout attempt failed, and we went back inside the prior ranges. And since then, every short-term rally has been sold into. So from here, I would not be surprised if Bitcoin falls to below $30,000, which is this low here. If the buyers manage to hold their ground, then I would like to see a bullish trigger, and my bullish trigger would be a move back above this bearish candle. So this large bearish candle is, when a candle like this is formed, you should usually expect further downside follow through. But if instead we go back above, then that would be a bullish development from a technical point of view. So the line that I've just drawn is at 36,800 or thereabouts. Ethereum or Ether, I should say, failed to hold above the trend line like Bitcoin right here. See this? It failed that breakout attempt, and since then, every recovery attempt has been sold into as cryptos remain under pressure. But unlike Bitcoin, Ether has already formed a bullish signal in the form of this hammer candle on the daily time frame when it took out the previous low and it rejected it, causing price to close well above that low. Since then, every dip has been bought back into support. For example, this candle here tested the high and it bounced. Price came back down to retest the high and it bounced after a few days. But now it's broken this support. So Ether is not looking as strong as it did over here or over here. Again, like Bitcoin, I'm now looking for a bullish trigger, and bullish trigger in terms of this coin comes in at 28.48. So if it goes above the high of that candle, that would signal to me that the market wants to push higher. Right, I can't see any further questions from you guys, which means that we can end the webinar. Unless you have anything else to say, please do so in the next minute or so. Otherwise, for those of you who have watched this on YouTube, just a quick reminder that you can join us live next time, because joining us live gives you an opportunity to ask me questions. And you can do that by going to our website, go to Market Analysis live website, live webinars. And here we have a list of upcoming webinars. We'll add more as soon as this webinar ends. And you can register by clicking on the register button. Okay, thank you so much for joining me. I hope you have a wonderful week ahead. Be careful out there, and join me again same time next week. Take care now. Bye-bye.